Hello there, Market Michael. It is March 31st. Now, what we got going for today is the upcoming banking crisis, the 2018 liquidity crisis. Um, any way you slice it, it's pretty much similar to what happened in 2008. Liquidity ran out, and it was a bad time, guys. It was a bad time. Alright, so I want to just cover the gist of what this video is, and I got some links to share with you guys today. Okay, so basically, we're looking at bank failures. Now, when these banks issue debt, right, or corporations, and it's like a chain. It's like a domino effect. People start not being able to repay the debts, and that it just gets carried up the ladder. Um, when a bank's assets, when the bank's liabilities are greater than the assets, it's insolvent. J.P. Morgan right now stands at $200 billion greater. The assets are $200 billion greater than their liabilities. Now, that's not really much considering they have $2.5 trillion worth of assets. And that doesn't really account of the stock or the bonds. And J.P. Morgan itself even thinks so. Now, we have to take into account the new Dodd-Frank, how do we call it, reform. And we have to also think about the, corporate debt. All the corporate debt, all these companies have the debt, The debt doesn't matter until it matters. That's great saying, and it's totally true. And if you think about us, we're not even that bad in shape compared to Europe or China. So think about that. And it just doesn't take. It's not like we're gonna go down right now. It's that if something happens, it's gonna create this problem, and it's just gonna start spiraling out of control, just like it did in '08. But this time, much worse, because the markets, the debt, everything was pumped up that much more. These companies, the Fed backdoor printed $14 trillion, and again, we had to get that audit in to see the specific audit to just see what they actually did during the '08 crisis. I'm surprised they got that through. Now, Europe, Italy is a disaster. I know Unicredit, Deutsche Bank, Germany, that's gonna absolutely fail. Um, you know, I know the J.P. Morgan's above with that $200 billion assets, but I mean, if their stock price goes, from $109 to $16, it's '08 low. I mean, their stock price, they can't even do they can't even that's part of their assets. You know what I'm saying? And the same thing with corporate bonds. Um, okay, so again, this creates a domino effect, and there's no you can't there's no containing this. It's just gonna melt everywhere. Okay, what did I write over here? Let's let's zoom in a little more. So the problem is assets are overvalued. Wow, no shit, guys. Assets are overvalued. Um, so when the system collapses, assets won't be worth as much as they supposedly were. Risky debt will be defaulted. This starts a long chain of failures. Now, that's pretty much sounds like 2008. Um, but this time, the stakes are much higher. Lehman Brothers was the biggest um, uh, company that happened to go under, that defaulted, and that was $600 billion worth of assets. $600 billion. That's it. JP Morgan is 2.5 trillion. How can, if is the government just going to bail everyone out again? I don't think so. I mean, they might. They might what they should do is let them fail. Um but there's a lot of problems here. Now, I'm going to get myself real small here. And we're gonna go over some articles. Now, this liquidity crisis is going to be a disaster. Absolute disaster. Okay, and this is what JP Morgan had to say about it. Okay, they coined the next term for the crisis, the great liquidity crisis, and Fed starts to unwind its balance sheet, but they're backdoor buying bonds. We could see it in the chart. Market crash could be a cruel twist of irony. Yes. Okay, so this is similar to the '08 crisis, when those accurately predicted the nature of GFC. What's GFC stand for? Global financial crisis, and started doing around '06. So JP says this. Um, uh, Highlights several specific market developments that have transpired to potentially create severe liquidity disruptions. Decreased assets under management of strategies that buy value assets. The shift from active to passive assets, and specifically the decline of value investors, reduces the ability of the market to prevent and recover from large drawdowns. Tail risk of private assets. Outflows from active value investors may be related into an increase in private assets reduce day-to-day volatility of a portfolio, but add liquidity-driven tail risk. Unlike market Unlike the market for public value assets, liquidity in private assets may be disrupted for much longer during a crisis. Increased assets under management for strategies that sell on autopilot. Over the past decade, there was strong growth in the passive and systemic strategies that rely on momentum and asset volatility to determine the level of risk-taking. A market shock would prompt these strategies pro- problem programmatically to sell into weakness. Um, Trends in liquidity provision. In market making, there's been a shift. Market so To quickly adjust the amount of risk taking, this trend strengthens momentum and reduces day-to-day volatility, but increases the risk of disruptions. Miscalculations of portfolio risk. This is what I was talking about earlier. Um, well, actually, I was talking about valuation excess. I think over the past two decades, the most models were correctly counting on bonds to offset equity risk. At the turning point of monetary accommodation, this assumption will most likely fail. Actually, no, this is what I was talking about. All those bonds that were worth something now are going to be worth nothing when they need to sell them. That is what liquidity means. It means how much you could sell without taking with how much can you sell, at a good current market price. If that market price goes to 2 from 100, that's not liquid at all. You're going to be taking a humongous loss. Valuation excess. Um, Given the extended period of monetary accommodation, most of assets are higher at the end of historical valuations. This is true in sectors most directly comparable to bonds, credit, low volatility stocks, as well as technology and internet related stocks. So where are we at right now? We're at the end of a bull market, and there you have it. So we have these problems. Um, The timing will be largely determined by the pace of central bank normalization, business cycle dynamics, and various idiosyncratic events, and hence cannot be known accurately. Alright, here's another one. Stress test results are out for Fannie and Freddie. This is from 2017. Um, and that JP article was from 17 as well. Okay, so what do we have here? Combined, Freddie and Fannie would need 99.6 billion in bailout relief under the severely adverse scenario. Big drop in housing prices, widening bond spreads, and market liquidity strains. And that's just Freddie and Fannie. That doesn't account for um, so they're better off, I guess, now than they were in the financial crisis, but that doesn't account for most of the other stocks. Okay. Um, every 10 years, this deserves a banking crisis. We are due. Um, this is looming mortgage liquidity crisis. And it's not just mortgage is one type of debt. There's all different types of debt that um, that I guess there's predatory lending on, and that's still going on. It's called the shadow banking. Um, we describe in this paper how non-bank mortgage companies are vulnerable to liquidity pressures in both their loan origination and servicing activities. And we document that this sector in aggregate appears to have minimal resources to bring a to bring bear in a stress scenario. Great. That's just great. Um, mortgage service Mortgage servicers have liquidity issues because they are required to continue making payments to investors, tax authorities, and insurance if mortgage borrowers quit making payments. So they have to finish out the term even though they defaulted. So if everyone starts defaulting, then that creates a humongous problem and that backs up, and then all of a sudden banks are failing, and then all of a sudden um, you know all of a sudden companies are failing, and then all of a sudden banks are failing. So just that it just keeps going on. Um, this is this was covered by the Money GPS, and I just happened to find this article and uh, cover the same thing. So pretty much, the more it goes into least affordable, the more the bubble is increasing. So we spiked up like in '07 according to this chart for affordability prices. Now we're in 2018, so and the amount of houses being produced is much less. I'm pretty sure I went over. I'm a little silly. I forget. I even covered the economic data and I forget what it is. Um, but that's that. Non-banks are vulnerable to macroeconomic shocks, rising interest rates, home price declines, job losses, often with bare minimum down payment. Um, Fannie Mae increased its DTI ceilings from 45% to 50%, and medium FICO scores are dropping. So FICO scores are dropping, and they're giving out these predatory loans again. Um, Deja vu all over again. Subprime and MBS demand oversubscribe, and S&P says risk is contained. Ha! Yeah, right. Um, we're basically coming up to '08 levels of mortgage outstanding. We're close to it. Whoops, we're close to it. Not yet there. If that wasn't disturbing enough, hedge fund partner quotes in the article says that subprime markets have a lot of room to grow, as if it was some new emerging market. Um, the Dodd-Frank report reforms relaxes a host of reporting requirements for small medium banks and smaller extent larger banks. So if these smaller banks start failing, again, that's going to create a domino effect. And for the reason why this is all a problem is because of fractional reserve lending. Um, you know, they're able to give out more money than they have. So when, you know, they don't have the money. The banks don't have the money. They get the money from the banks, the corporations, and then the consumers aren't buying, so they go bust, and the banks have to absorb everything. Anyway, um, damn, out of water. Um, what do we got here? So, relaxes stress testing requirements intended to show how banks would survive another financial crisis. Raises threshold for banks who are not subject to enhanced liquidity requirements. Um, so that's not good. From 50 billion to 250 billion. So that's pretty bad. Allows mega banks such as Citi to count municipal bonds as highly liquid assets that could be used towards the liquidity coverage ratio. Boom! There you go. That's literally it. That's literally it. That they're counting these bonds towards liquidity. But bonds aren't liquidity. You can only sell X amount of bonds before the market's saturated and the bonds aren't worth anything. Who's going to buy all the bonds? Um, you know, I guess they would be juicy yields, but who's going to pay the yields if they're all going under? I mean, it just doesn't make any sense. And this hasn't made sense for a long time. And it's a fucking shame. So this, I just wanted to show you guys. This is J.P. Morgan's total liabilities, 2.277 trillion, and here we have 2.533 trillion. And again, they're counting bonds as liquid assets. So that's a fraud. Um, you know, the problems of '08 were never fixed. And they say everything's fine, everything's great, everything's normal. Um, everything's not great. This country backed itself into a hole, and the only way to get us out of this hole is to actually start producing and start becoming paying off the debt slowly, and you know that's how it's done. You can't just borrow into infinity. You can't just quantitative easing into infinity. And now here's a good point here. So quantitative easing, right? You can only okay. You can only print so much bonds. Well, that's not true because look at Japan. Japan's just like Japan's buying their stocks and their bonds. So at what limit, you know, you have extreme, you know, I guess inflation in a sense. But I guess possibly what's going to happen in this liquidity crisis after the liquidity crisis, they could possibly instead of purchasing, like Ben Bernanke wants to do helicopter money, and that would be direct hyperinflation. Now, it depends on what they do with the quantitative easing, whether they want to, invest it in bonds or whatever the fuck they're doing. But in the end, it's not gonna be good. Um, it's a disaster. It's a disaster. This is gonna end in a disaster. And it's kind of crazy. I think the stock market is the thing that's gonna prick this bubble. Everyone's invested so heavily into the markets, and the tide is already went out. It's anyone can see it. If you've been looking at the markets, you know that this isn't 2017 anymore. It's not. It's simply not. Things have changed, um, you know, and um, And this is what we're looking at. This is going to be the next problem. This is going to be the next problem, the liquidity crisis. Now, what's going to happen because of this? Well, companies are going to go under. Um, the banks are going to fail. Now, how the central banks handle it is they might do the negative interest rates. They might do all kinds of crazy stuff. Helicopter money. It's getting ridiculous. I don't know how many more cycles we can take of this. I really don't. Um, how many more cycles we could take of this? People say, "Oh, this crash is going to be the next big one that kills us." No, I don't think it will be. I think there's going to be a couple more normal cyclical crashes, and then we're going to get the one giant big deleveraging where the entire country fails, and it's going to be a mass that we're not there yet. We're not there yet. We got it. We could kick the can down the road much longer, but why are we kicking the can down the road? It's just absolutely absurd. I don't understand it. None of this makes any sense. I mean, we're just dividing the gap between the poor and the rich even more. Every time we do this, there's a consolidation of power. In the big corporations who survived the financial crisis just buy up all the little corporations. Look at Amazon. Amazon's freaking huge, and it's a monopoly. And supposedly uh, their retail loses them money, and they're subsidizing the retail through their other portions of their business. So it's literally killing the competition and losing money on it. It's bizarre. It's absolutely crazy. So I don't know what the solutions from the central banks are going to be, but this is pretty much what I can gather is going to happen. We're going to have a liquidity crisis, and the stock market, I think, is the indicator that pricked this bubble. Like the stock, I don't even know. The stock market will cause this crisis. Um, that at least that's what I think is going to happen. Maybe comment down below. Tell me what you guys think. Start up a conversation. Not many of you commented on my videos, and go ahead, put a comment, put a like, subscribe, please. Tell me what you guys think. What do you guys want to hear? Um, I just think that this liquidity crisis is obvious. Um, and they didn't really get to fix any systemic problems. On TV, on CNBC, I like Greg Manarino. He says the Confederacy of Dunces, and you just gotta laugh because that's exactly what they are, a confederacy of dunces. They just say whatever the fuck their producers want them to say. Um, you know, and it's absolutely hilarious. It's fake news. So, if you're listening to them and thinking the economy is great and that the economy isn't going to crash because corporate earnings are going to be high this year because of what CNBC says, then I mean, oh gosh, that's just horrible. you know, these problems are systemic. They're way deeper than um, you know earnings. It goes to this whole notion of debt and understanding uh, Keynesianism isn't uh, Keynesianism isn't good. You can't just expand your debt without any negative results. I mean, it's pretty obvious what happens when we take on risky debt, you know, and the more you allocate resources to things that are going to fail, the worse you're going to be, and the bigger the meltdowns are going to be. So if you think the $600 billion Lehman Brother failure was bad, wait till these banks with $1 trillion uh, trillion-dollar at like balance sheets, wait till they fail. It's going to be a whole new ball game, and it's going to be really interesting to see what goes down, and different factors that go along with that. Well, thank you very much. This is Market Michael. Um, you know, I'm sorry I didn't get a lot of videos out. I've been pretty busy this weekend, so I got a lot of videos coming out. Maybe possibly more today, more tomorrow. I was gonna get a shaving video out, but I fucked up on the fucking shaving video this morning. You see, because this is what they call a baby smooth face, baby smooth, and that's what I like. Um, Please like and subscribe if you want more content like this. Thank you very much, and take care.